AutoNation, the country's largest automotive retailer, reporting fiscal third quarter numbers. And here now, first on CNBC with those numbers, Mike Jackson is the chairman and CEO of AutoNation. Mike, good morning. You're on with Andrew Ross Sorkin and Ken Langone. I know we put the numbers up on our screen a few minutes ago, but if you can go over them again, we'd appreciate it.
Carl, good morning. Good morning, everyone. Well, for the fourth quarter in a row, we had significant revenue growth and EPS growth, achieving 39 cents per share in the third quarter. That's an 8% improvement over the cash for clunker performance of a year ago. A total revenue increase of 13%. All fields of our business increased revenue, led by used vehicles up 30%, and the revival of our domestic business up 22%. But no question, the overall business environment in the third quarter was tougher than the second quarter. So to drive those share gains and those revenue gains, we narrowed our margins by about $75 a unit, which doesn't sound like much unless you consider we sold 100,000 cars in the quarter.
It's sort of an echo of the good numbers we got out of Ford earlier in the week, yesterday, and their forecast for industry volume this year. Is anything on the horizon concern you? Inventory levels, anything like that?
Well, I'm more in Ken Langone's camp. I'm very worried about the election and the political environment. You know, we forecasted that the industry would sell about 11.5 million units this year, and it's on track for that. But that means the fourth quarter has to have a selling rate of up over 12 million. I think the election is pivotal. I think the expectation is, or the hope is, that we get Washington out of the way of this recovery. We're in a deep, great recession. The recovery is anemic overall, and we simply can't deal with healthcare reform, regulation, uncertainty around taxes, and drive this recovery. So I think the election is pivotal. I think what the Federal Reserve does later in the week is pivotal. I'm optimistic that all the right things will happen, and the recovery in automotive will continue into next year.
Wow, Mike. I mean, the good times didn't really last that long, really. I mean, you had to discount some. That's a pretty big hit to margins, right? And the numbers are below expectations. So you definitely it wasn't. I thought this was going to last 3 or 4 years. It lasted a couple of quarters.
Well, I'm not saying this recovery is out of gas whatsoever. Here, I would describe it this way, Joe. During the downward spiral, we were very conservative and in a defensive posture because we were determined that when this industry finally hit bottom, we would be in a very strong position to take share in the period of the recovery with all the collateral damages to all the businesses. So that's exactly what we've done. And as the environment got tougher in the third quarter, I'm not going to hit the brakes to make some analyst number for the third quarter. We're going to continue the momentum. If I look at our year-to-date performance in this very tough environment, we've increased revenue 17% year-to-date, and we've increased earnings per share 27%. And and looking forward in the next couple of years, I still continue to see a big share opportunity for our company in this recovery. So the share we've taken will pay dividends open-ended in the future. And yeah, we had to narrow margins considering how difficult the environment got in the third quarter. But we're already adjusting here in the fourth quarter to stabilize it. And hopefully all we need is a slightly more robust recovery, and we can get that $75 a unit back.
Hey, Mike, Ken Langone, how are you?
Yeah, Ken, I'm very good.
Mike, how many years do you think it'll take to get back to 15 or 16 million cars?
Yeah, I think the crash, first into a cyclical recession and then into an automotive depression from peak to trough, took 2 years. I think we're looking, if all the right decisions are made from this point forward, I think it's a 4-year journey back to 16 million units. I think we'll eventually get there, but it's a longer journey.
Is it, at that point, will it be sustainable at that level, do you think?
I really do. And I think the big difference on both sides of the divide, Ken, is that before the crash, the industry had a production push business model that was not sustainable and was leading towards inevitable bankruptcy for major players. All that's been swept away by the great crash. These are businesses that are now focused on viability, sustainability, profitability. And if you're a rational competitor like us, that's all big pluses to be in a much more rational environment. And automotive never had the excesses around credit like the housing industry did. It never abandoned its underwriting standards. It went too crazy with incentives, but that's another story. That's more easily fixed. But the underwriting standards for credit remain firm.
Real quick, Ken made a very smart point earlier about the valuation or the upcoming valuation of GM on its IPO, and I was curious if you had a view. His view, of course, was that it was overvalued on a relative basis.
Well, I think, I'm no expert on the GM valuation. I'm not going to make that statement. I think, though, in principle, when you look at the domestic manufacturers, people have underestimated how much these companies have been revolutionized. And here I agree totally with Ken, led by Ford Motor Company and Alan Mulally, who was able to do it without bankruptcy and without government aid, very much to be admired. And as the volume, as this journey back to 16 million happens, the profitability is going to be so much higher at every level, supplier, manufacturer, and retailer, because we're in a much more rational business. I think people are going to be surprised on the upside during this recovery.
Interesting stuff.
Mike, thanks. Good to see you.
Mike.
Great seeing everybody this morning. Thank you.
Mike Jackson joining us from Fort Lauderdale.